So the key message of Chris is like the market did not hit the top yet. Um,
Yeah.
yeah, but
One, two, three, four.
All opinions expressed by Chris, Michael, Zach, and their castmates are solely their own opinions and do not reflect the opinion of 5i Research. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Employees of 5i Research may hold positions in the securities discussed in this podcast.
Welcome to the 9th episode of The Exponent with 5i Research. My name is Chris. I'm the head of research with 5i, and I want to welcome you, our listeners, to our journey into the heart of the Canadian markets. Our mission is to empower investors with precise insights and in-depth research into stocks, the economy, and more. With that said, let's dive into the Canadian and U.S. financial landscape. So today we have a very special episode for our listeners. I'm joined by both my co-hosts, Zach and Michael. Welcome, guys.
Hey, thanks,
nice
Russ.
to be here.
Yeah. Glad to see you both here. So big episode today. Since we last recorded, it was the late summer. A lot has happened since in the markets. We've gone through an earnings cycle, which was pretty good, but also the US election, which following the results, the market has been trending quite nicely since, and we're coming into kind of the holiday season here and maybe a bit of a Santa rally. So this will be the last podcast of the year. But also it will be Zach's last podcast of the year, or last podcast ever, since he'll actually be leaving to pursue other opportunities elsewhere. So this will be a pretty special episode here. So final send-off kind of episode. Yeah, so we've got a lot to talk about. First, we're going to dive into Canadian small cap names. So Michael, do you want to start off with your small cap name?
Yeah, sure. Okay, so the small cap name I want to talk about today is Kneat.com. The ticker is KSI. So the company operates as a healthcare SaaS business and that provides solution for data and document management. Its target customer is from pharmaceutical, biotech firms, and medical device manufacturing companies. So validation, lifecycle management, and testing is highly critical, but also really complex for a highly regulated industry like healthcare. And KSI, as for in the last 5 years, its revenue has grown at on average 71%, driven mostly organic. And the consensus estimates that KSI will continue to grow by at least 30% over the next few years. Really strong growth there. And also, the company has a really solid gross margin, 74%, typical SaaS business. Strong balance sheet, no long term debt, very reasonable stock based compensation. Uh, Although the company is now unprofitable yet, but it is currently at the turning point in terms of profitability and cash flow. Um, and also, for example, in the most recent quarter, KSI's revenue growth reaccelerates to around 52%. Investors uh, can start to discover high quality growth story again when the market hits new heights, and KSI would be one of the first to be like discovered. The share price has been on solid momentum, but I think it still have room to run from here, especially with the acceleration in the top line growth. KSI is trading at 12 times EV to sales. It is not cheap, but for SaaS companies growing 50+%, that multiple could be justified. Yeah, so I think that name would be an interesting name to watch from here.
Nice. Yeah, no, I love the chart here too. It's just like really simple but illustrative of, the high revenue growth rate as you were kind of talking about, but also just that massive compression in its sales multiple. I mean, like going from, I think it's even on a log scale, but it went from like 150 times EV to sales to now just 12 times, which on an absolute basis, 12 times is pretty expensive. But considering that high growth rate, I mean, if it could continue to grow its sales at like 40 to 50% even in the coming years. And then the stock price can go up slightly less than that. You can continue to see some sort of like sales multiple compression. So yeah, no, it's a great company, great chart. I like that.
Yeah, looks really good. I was going to say the same thing. Like, it's nice to see the price going up and your sales multiple coming down, not like the sales multiples coming down due to like any price action. So, it's showing that like solid growth and it's getting cheaper because it's growing, which is always a good thing.
Yeah. Nice. Basically, the larger it gets, the cheaper it becomes.
Yeah. Good scale. Good way to scale. Yeah.
Definitely.
I like it. Okay, cool. So I guess we'll move on to Zach's pick here.
Yeah. So my pick here is Zedcor, ticker is ZDC. They're a Calgary-based security and surveillance services company. The stock's done really well, as we can see here with, it's up 460% year to date. So the momentum's super high, but it's still definitely a small cap name at just 312 million in market cap. But, momentum's been great and it looks pretty attractive. So what Zedcor does is primarily they service industrial and commercial consumers through their mobile IZ security surveillance and monitoring towers. So they pretty much just manufacture security camera towers, and then they also provide the live video monitoring services where the video is monitored live from their office in Calgary, and it's monitored 24/7 by a group of like trained professionals. So I think the technology is pretty interesting there, but the actual business model is pretty interesting in itself, where they use what's called like a hub and spoke business model. So that's where, the security towers are deployed all around North America, and then the live monitoring, it feeds back into the headquarters of Calgary. So it allows the business model to be a bit more scalable, and they've got a really highly sticky recurring revenue base with 75% of revenues being recurring. And they've also got some really strong customers, like blue chip people like DR Horton and Home Depot. So the business model's quite attractive. Just looking at the fundamentals on the next slide here, we've got yeah, so things are looking pretty good. We can see the revenue growth's been quite strong. And while, profitability, there's been a bit of like upward and downward movement with the EBITDA margins. The gross profit margins have trended up pretty nicely, and that's really contributed to the overall like momentum that we've seen so far this year. And then just to speak to valuation on the next slide a bit, we can see it's pretty expensive at 81 times forward earnings. But the nice thing is that analysts have been pretty bullish since they started covering the stock this year, where the forward outlook has been upwardly revised for both EPS and revenue. So things are looking pretty good. It's expected to grow at a high rate in the future. And there's also a few catalysts for it going forward, being US expansion, because it's primarily in Canada right now. And then also there's sort of the technological side of things too, where certain companies are looking to shift away from the traditional security guards into more of technological aspects, like companies like Zedcor with those like monitoring and live camera feeds. And it's just because it's becoming so much more expensive to actually have physical security guards. So I think they present, a cost savings angle for customers as well that should help them grow.
No, that's great. Yeah. It's I really like that aspect of like replacing manual security guards because it just kind of like scales up that whole business. I'm sure down the line they can incorporate some sort of like AI aspect to it and really just ramp up, the ability to scan for anyone in the purview of the cameras and the tech and everything. And from the analyst perspective here, the upgrades, it's really interesting because they completely jumped on the EPS estimate for the next 12 months. And that really brought down the forward PE from like 135 down to 55 just overnight, just because of raising their guidance. So, and then obviously PE expanding again was as a result of price coming up kind of in response to that immediate upgrade. So really good to see those sorts of price actions. And then also, just the core thesis is pretty interesting too, just replacing manual labor and just kind of scaling that up. So it's a good name.
I'm just gonna echo what Chris just said. Although the name looks like optically expensive at like 80 plus times for PE, I checked the analyst like consensus estimate, like the sales growth over the next 2 years is gonna be around 50%, and there's not many companies that can grow its top line like 50% plus. On like whether it is sustainable is like another story, but 81 times for PE would be compressed really quickly if they can sustain that high growth rate.
Yeah.
Uh,
Yeah.
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 Yeah, definitely a high momentum name. I think just to the AI point there, Chris, they actually do have a bit of AI technology on their like threat detection for their cameras. I don't
Oh
know if
yeah.
it's like a big
Okay.
core element of the business right now, but they do mention it that in like the threat detection, they use like AI and things to send out like the first threat detection to their the people monitoring the cameras, and then from there, that's how they really like determine whether or not to call the police
Right.
or take it to authorities or not. So yeah.
That's an interesting name for sure. And yeah, definitely one that's like, a small cap name, priced expensive, but it's a good lesson in like why it's sometimes, you know, important to buy expensive stocks because, you know, they're sometimes priced expensive for a reason. And that's likely that they're growing fast and then they can really grow into those multiples. And if you're right and you're early on that name, investors can make a lot of money by being right and early. Okay, cool. So on to my name. So this is a name that we've recently initiated coverage at 5i Research. So it's VersaBank. The ticker is VBNK. So this is a Canadian chartered bank. They operate like solely digitally, no physical branches. And the core thesis here is that it has this innovative deposit and lending solutions kind of business for financial intermediaries that allows those financial intermediaries to focus on their core businesses. So the interesting part is its point of sale loans. So basically, VersaBank will purchase loans and leases which are originated by point of sale lenders. So these are lenders that finance consumer or small business purchases. And VersaBank doesn't even need to directly interact with these borrowers. So, for example, a consumer might be purchasing a dishwasher at an appliance store. The appliance store offers a loan for that appliance, and VersaBank will just purchase that loan from the appliance store without, really digging into who like they don't meet with the customer face to face. They just kind of go through credit score and all these other aspects and look at all these metrics. And this provides immediate liquidity to the point of sale lender. And so this is a real like core piece of VersaBank's operations, and it's seen like some massive growth from this area. It's also recently been expanding into the US with a recent acquisition of a small US bank. So overall, it's an interesting play. They have a good risk model on its loans. The loan loss provision is extremely low, especially given that it doesn't even meet with its clients. It has sticky deposits and this really cool, innovative tech platform. And then looking at some of the metrics here, so we can see the market cap alongside kind of its price has been climbing over the years. It did fall in 2022 alongside other stocks, but now it's at a pretty healthy level above 500 million on the market cap side. So getting up, close to nearing in on a billion eventually, probably. And then price to book, it's at just about 1.5 times. So that's been expanding. But I think that's alongside optimism around its expansion into the US market. And then ROE has really, grown over the last couple of years. So it's around 16%. And so I think the goal for the company is kind of hover around that mid-teen sort of level.
Really interesting bank. The thing that get me kind of interested in that is most Canadians bank like pay out like most of their earnings in dividends and buybacks, and this company seems to like retain the majority of the earnings to grow
Right.
along with like the growth in like deposits. So it could be an interesting like compounders in the banking industry if like they keep executing.
I think also like just being able to like drive operating leverage with that business model where you're totally branchless, which for most banks that's a big
Yeah.
part of their model. And like I think that's something that can slow down their expansion as well, especially when you're a smaller cap like banking kind of company where you physically have to go and open up different branches if you want to regionally expand. But with VersaBank, they made that acquisition now, so they're almost instantly in the US market, and it's pretty easy for them to get those increased commercial activities in the US market. So now they have, a component of both there.
Yeah, no, it's a really good point too. Yeah, it's something the company even mentioned is that since they don't have branches, they don't have nearly the same expenses that most other banks would, and that kind of allows them to see rapid margin expansion and profit growth. And then yeah, Michael, like you were saying, they don't pay out dividends or anything really in a meaningful way. So a lot of that just gets reinvested right back into the company. So you can see some nice kind of capital appreciation potential there. Okay, so that's the Canadian small cap name segment. So some really seemingly high quality growth names, and especially we're looking at names with like a lot of good momentum recently. So that's quite a positive thing to see. And then the next segment is on our most recent blog edition that we're doing called Rockets and Duds. So I'm just going to put up on the screen kind of what this looks like. So this is basically our newest weekly blog post that the founder of 5i Research, Peter Hodson, he's actually writing and publishing this each week. So he basically goes through a series of US and Canadian stocks that he feels are either rockets or duds. For example, in the most recent edition, he talks about AppLovin. The ticker is APP. It's a tech company using AI to match advertiser demand with publishing supply. It's up, 900% this year. Absolutely a massive run. And it had really strong earnings and guidance recently. He also talks about Palantir, Nebius, which is a former Russian company that's involved in AI, data mining, crypto, GPU hosting. So really interesting weekly blog that we're putting out. And I think a lot of members and just anyone that wants to head to the blog side of the website can find really interesting. We talk about a whole range of Canadian and US stocks there. So yeah, so just thought I would highlight that recent addition to our blogs, and I think people will find this quite useful going forward.
Yeah, I think this is one of the favorite blogs I've seen that we've put out since I've joined. It's definitely highlights some interesting names, and what's some of those like interesting ones that have just been flying recently, and also some of the ones that
Right.
have been making
Yeah.
the tough downward moves as well. So it gives you an interesting view on both of them.
Yeah, that's a good blog. So yeah, just wanted to highlight that. But moving on to the next segment, we're going to be talking about base hits from 5i for 2025. So I think Zach, this is kind of your piece here.
Yeah. So base hits. So we've previously done this segment once before. And just to review like what a base hit is, if there's any new listeners out there, you might have forgotten. So a base hit is pretty much a stock that we see as like a set it and forget it type of investment. It's something you can buy, hold it for the long term. It ends up being, relatively low risk, and you don't really need to worry about it on like a quarter to quarter basis because you're pretty confident that it should do well over the long run. So just to review the three that I mentioned the first time when we did this, we looked at Brookfield Corporation, Constellation Software, and ATD. This is just the year-to-date performance. I believe we aired the podcast in August for the initial one when we did base hits, but just looking at these from the start of the year, they all done pretty well. ATD's lagged a little bit, but still, we're still pretty confident in that name and think that there's a lot of good things to like. So just quickly reviewing them, but we can see that Brookfield and CSU, continue to just keep up that great momentum. And yeah, so those are the previous three. The current three that we're going to be looking at here are Dollarama, Thomson Reuters, and WSP Global. So the typical criteria and the criteria that we used for the previous three as well was just companies that have strong track records of growth and execution. they've got experienced management teams, and then they have some sort of leadership position in their respective industries, which is a key factor as well. So for Dollarama, we can see, just very nice price action and a very high 10-year CAGR. And then also just that ability to consistently grow revenue and EBITDA over a long-term scale. So pretty nice trends there for Dollarama. And it's, an interesting one because in the Canadian market, dollar stores and Dollarama is really like almost monopoly in a sense. Whereas in the US, it's not as attractive of a business because it's a much more saturated market. So Dollarama really has a competitive advantage there. Next one is Thomson Reuters. So similarly, we can see how that return's just been very high over time, especially on a long-term scale. And the company's done really well at growing their revenues as well as profitability. And then lastly, WSP Global, one of the real leaders in that sort of like consulting, engineering, professional services space in Canada. And yeah, done a great job at growing, picking up contracts, being a trusted partner. And we can see that continuing in the future. And yeah, so three good names that we like there. And we think heading into 2025 could all do pretty well and continue to be base hits.
No, it's great. I like all of these names, and I mean, I love the base hits sort of idea because like these are all names that continue to make 52-week highs usually, and they keep going up. Sometimes they even get a little bit more expensive on a valuation kind of side of things, but that just shows like that they deserve that premium valuation most likely. But also, it's interesting because like we always hear, like especially with Constellation Software and other names like that, that investors always feel like, okay, it's gone up too much. It needs to come down eventually. But what we always see is that the good companies that execute well just continue to execute well and kind of continue to see new 52-week highs. So a great lesson in like owning really high quality stocks and just kind of continuing to hold on to them for the long term.
Yeah, my take is like a basket of these names should do like really well for investors over time. And I think the common theme among these names that not many people discuss about is like they possess not only like pricing power, like ability to raise prices without losing volumes, losing customers. They also possess significant like staying power. So like AI or any new kind of technology would highly disrupt these businesses, but could be a long-term tailwind in terms of like cost efficiency for them. So I think that's the point that really interesting with these names.
Yeah, that's a great point, Michael. Just having that like strong pricing power amongst them, where you have that ability to raise prices and you can get the new contracts and everything, but you're also like a trusted partner where people like to work with you, and then also you're innovating and things as well. So you're just good for your customers as well. I think is really important with these names.
Awesome. Okay. That's yeah, we'll have to follow up on those names in the new year and kind of see what's going on. But I'm sure if the markets are higher, that there's a decent chance that these names are also higher. So the next segment, I'm going to talk about why we're bullish on the markets and we think investors should be too. So this is a recent article that I've written for our members, and basically it's kind of a whole like culmination of different charts, different things within the macro side of things, as well as just the broader markets as to why we're still bullish on the markets. Even though, the markets have been roaring higher year to date. And some investors might feel that, okay, we're due for some sort of like big pullback, or, things are too good to be true sort of thing. But I'm still quite bullish, and there's several charts that I have that kind of indicate that. So this first chart that we have here, this is a trend that I've noticed across, small caps, mid caps, and even the equal weighted indices. So what we're looking at here is the small cap ETF. It's the IJR ETF, but it's the S&P 600. So it's basically, the viable, profitable 600 small cap names in the US. And so we're looking at it across time, and the blue vertical dotted lines are basically US elections. So a trend that I notice is that going into US elections, the small caps tend to consolidate at their previous all-time highs, for about 1 to 2 years heading into the election. And then following the results of the election, regardless who wins, the small caps tend to see about a 30+% gain over the next 1 to 2 years on average. And it's a really like strong, drastic move higher. And so what we see, there's a couple reasons for this. One is that there's so much uncertainty leading up to a U.S. election that investors kind of aren't sure how to place their capital. Businesses are also kind of in the same boat where they're unsure of capital allocation policy or how to like where to invest, and things like that. And then following the U.S. election, there's a lot of certainty. And so if there's one thing that the markets don't like, it's uncertainty. So following that kind of release valve of certainty or uncertainty, we tend to see some really strong moves. So that's something that I'm looking out for the next 1 to 2 year period. And this is also kind of in line with mid caps and equal weights also breaking out. So looking at the stats for this, what I did is I looked at the forward 1 month, 3 months, 6 month, 12 month, and 24-month returns for the small caps following each historical US election result, dating back to 2000. So we can see a few outliers like 2000, 2008, where the forward returns were mostly negative. But this is because those were bear market years. 2000 was the dot-com bubble. 2008 was a deep recession. Outside of those, when we look at excluding bear markets, so excluding those 2 years, the average forward returns are extremely strong. Like forward 1 month is up 10%, 3 months, 16%, 6 months, 21%, forward 1 year, 31%. So, following the results of the US election, historically, we've seen some really strong returns in the small cap space. Another reason why we're bullish on the markets, what I'm looking at here is we're looking at high yield credit spreads. So that's in the orange area graph. And in the bottom is the S&P 500 over time. And so what the credit spreads measures is basically how much risk there is for corporations and their ability to pay back their debt. And so when that spread is narrowing or coming down, it basically says, okay, there's a good chance that these companies are healthy, they're able to pay down debt, maybe interest rates are dropping, and that's part of the reason. But generally, it's kind of a risk on indicator, as well as signaling that the economy is healthy or it's improving, and thus corporate profits are also likely improving. And so we can see that the credit spread narrowing or dropping is congruent with bull markets and the S&P 500 seeing really strong years. If we look at the credit spread and when it widens or when it rises rapidly, that's also in tandem with bear markets. But what I really want to focus on is most recently, the credit spreads have been absolutely dropping, just kind of dropping like a stone. And that's really indicative of a risk on market, a healthy, improving economy, like particularly on the US side. And thus, for me, kind of further confirmation or validation that we could likely see continuation of this bull market. And then lastly, I'm looking at the Russell 2000 small caps index and its breadth. So this is a measure that I've created. It's the 1 year breadth. It's essentially looking at the percentage of stocks in the Russell 2000 that are higher on a year over year basis. So right now we see about 50% of Russell 2000 names are higher on a year over year basis. Whereas typically we see bull markets end or kind of top out when that percentage reaches like 70 to 80%. So when almost all stocks in the Russell 2000 are up year over year, that's usually a good sign that like, okay, this bull market has seen its run and it's kind of taken its course. But we're not even close to that right now, and we're really just breaching above 50% right now. So to me, this signals there's a lot of room left to run, especially on the small cap side.
So the key message of Chris is like the market did not hit the top yet.
Yeah.
Yeah, but no, I just want to add one more point. Like, so recently we received lots of questions like the market keep reaching new highs and is it a top signal, or Buffett sold stocks and hold
Mm,
cash? Is
yeah.
it really a top signal?
Right.
There's some signs here and there of a slightly frothy market, I would say. But like the Criffy index, the indicator I usually use is still like neutral. And also I like opportunity investors can always like find opportunity somewhere if they look hard enough. Like there's
Mhm.
thousands of stocks, and
Yeah.
some could be like fair to overvalue, but we will certainly find opportunities if investors do the work.
Yeah, and I think, what all these charts really show us is just how important it is to stay invested, like over the long term, especially those first few you went over. Like we can just see every time after an election, like we get a big jump in the small cap IJH. So it's just really important to stay in the market. And, we get a lot of questions, similarly like, oh, Trump trades and ways to play certain themes and if certain sectors are going to go down. But I think maintaining broad market exposure is just very important. And then knowing in the long term, it really, for the market, it's not the biggest thing. And the biggest determinant is who's in office is not, it's not the most important thing. There's a lot of other factors out there. And I think that's what, a core theme across all of these charts.
Yeah. Yeah. No, definitely. It's those are really good points from both of you guys. Like, on Michael's side of things, like you were talking about, like there's always opportunity somewhere, and that's honestly one of my favorite like mantras in investing is that even if this breadth indicator were to reach like 80% and it signaled some sort of potential, near term top or something, like you said, there's always opportunity somewhere, and there's thousands of stocks out there, and something will likely be doing well over the coming year in that period, and it's just kind of like looking out for those opportunities and making sure that we're always on top of them. And then yeah, Zach, on your point, I mean, it's definitely true that the consolidation period leading up to the US election is also when there's always the highest uncertainty from investors, or periods of boredom where people likely give up on these stocks. But that's usually the time to kind of get interested is when others are getting bored or things are taking too long. Like investors are getting impatient, because that could likely signal that things are about to break out. And patience often gets rewarded in the markets. So yeah, really an interesting point there. Okay, so we have one last segment for today. So this is Michael's going to be looking at one interesting US ETF.
Yeah, sure. So we at FiveEye are really big fans of like compounders in general. We have owned names like CSU and Brookfield for our model portfolio for years now. And the ETFs that I want to discuss today is kind of resemble that theme of owning compounders. Um, so the name of the ETF is Free Cash Flow International Quality ETF. It is a US based ETF that focus on the theme of owning like compounding machines in the international markets. Um, so the key is companies that can generate like growing free cash flow consistently year after year, regardless of external pressures, send a really strong signal of the quality of the business. And these companies tend to have other very favorable characteristics like high returns on capital, strong pricing power, capital light, etc. And here the ETF is interesting is it kind of focus on the international market because like unlike the US market where it seems like all high quality names are really well covered, the international compounders are like largely unpopular to the mainstream investors. And this ETF like TTAI could be a low cost way to gain exposure to that theme. So the ETF is pretty much a niche strategy with AUM of around 112 million and an expense ratio of around 0.6. And uh, it owns some really high quality compounders that even US investors are not familiar. So for example, it owns some names like Roche Holding, like it is a Switzerland pharmaceutical company, or RELX PLC. It is basically a UK-based consulting firm, or PDD, like a Chinese e-commerce player. So I think it owns some of the Canadian names too, because this is like international. Canadian equities is considered like international equities. But I think as a group, these names are uh, potentially long-term holding candidates that could compound shareholders' capital at really attractive rate over time. And the only advice in when investors that look for compounder is for the ones who are fortunate and skilled enough to own these companies in the early days. The proper course of action is probably do nothing. It is a pretty easy thing to say, but really hard to do. But that's the only advice, like in owning compounders. And overall, I think like this ETF, TTAI, like provides investor in a really low cost and diversified ways to get exposure to compounders in the international market that are usually overlooked by investors.
Yeah. Yeah. No, it's a great point. Yeah. And it's good that, yeah, it is international, because I think we are seeing some like really good value in the international markets. And then looking at the holdings here, pretty high quality list, and, you know, the number one holding, Dollarama, that's like, again, pretty validating to our kind of base hit segment. And just like investors that held Dollarama over the years, probably at some point were like, okay, this has gotten too high, too expensive. It's just a dollar store. But, you know, really we see dollar stores like Dollarama be pretty resilient across the business cycles, and kind of, you know, pretty recession proof to some degree. So yeah, lots of high quality names, and yeah, interesting ETF for sure.
Yeah, I think the value point is really important there, because I know a lot of like investors, we kind of talked about it a bit earlier, people are concerned about the valuation of the, US market and things, and there are good value opportunities in some of the international markets. So I think having this like active sort of strategy where you're going for the top quality names, which are, in a lot of cases cheaper than maybe similar or lower quality names in the US market. It's pretty interesting, and it's a low cost option too. So that is definitely a good fund to look at.
Yeah, sure. I hear you guys. And yeah, I just want to echo on Zach's last point on valuation. Like investors are usually concerned about like whether these like Dollarama, whether is it slightly overvalued, etc. So I think the key points in owning like compounders in general is whether the growth engine is still there, like whether it is through acquisitions or like through organic growth, etc. Whether the engine is still works well, rather than like consider it is like 10% slightly overvalued or 10% slightly undervalued. Those points doesn't make sense in owning like high quality companies.
Okay, awesome. No, that was great. Okay, so we made pretty good timing here. I'm impressed for the three of us. We accomplished a lot today, so definitely that's great. So yeah, that's all that's all the segments that we have for today. We hope that you enjoyed this episode of our podcast and learned something new about the Canadian and US markets. If you want access to more exclusive content and insights, don't forget to visit our website at 5iresearch.ca and sign up for a free trial if you haven't already. You can find the link in the show notes below. And if you like this video, please give us a thumbs up and subscribe to our channel for more updates. Thank you for listening, and we'll see you next time.